Hey, good morning. My name is Britton Johnson. I'm the founding partner of Voluntary Insurance Partners, and we work with employers that truly care about their employees. They think of their employees as family. They want to do something for them when it comes to benefits, but understanding a budget comes into play. That's where we shine. So if you're an employer, definitely get with our team. Go to voluntarypartners.com, hook us up, and our people will be happy to take care of you. I've got one of the best insurance teams in the world, and I'm so proud of my people. All right. So today's episode, we are continuing about commissions. Now, previously, you heard me talk about advanced commissions versus as earned commissions. You heard me talk about first years versus renewals. You heard me talk about vesting. If you need more information on those terms and what they mean, check out my previous videos. I believe it's worth it. And be sure and give us a thumbs up, a like, subscribe. Just comment in the comments. It helps the algorithm and helps push us out further. So thank you in advance for doing that. I hope you find this information very beneficial to you. All right, so let's talk about what it means to have heaped versus levelized commissions. Now, you go, wait, what does that even mean? All right, so heaped commissions means that in the first year, you make more percentage points, right? It's heaped. And then every renewal year, it's a lower percentage. Let me give you an example. One of our standard products will pay you 45% of the annualized premiums in first year, but the renewal is 5%, okay? So 45% of the annualized premium in the first year, and the renewal every year, and you're vested on day one with us, so every year, you would make 5% of that annualized premium each year thereafter. Now, you could transversely offer levelized, okay? That is equivalent to 12% every year. So yes, you would make less in the first year, but every year you would make more. Now, typically the break point is about 4.5 years. So if you have a company where the employees, you know they're gonna be there for 30 years plus, it might make sense to go levelized commissions, right? You're selling really good products, you're selling really good benefits to those employees, and they're benefits that people are gonna wanna keep. So ultimately, you would make a lot more in the long run by going levelized in those scenarios. Now, don't confuse that with advanced or, as earned commissions. That's how you get paid. We're talking about the percentage that you get paid here, okay? So heaped means there's more in the first year and less in the subsequent years in those renewals. Levelized means it's the same every year. Let me give you an example. Dental insurance. One of the most common, the industry standard for dental insurance is 10% of the annualized premium, and that is level. So every year that someone has dental insurance, so if someone is paying $1,000 a year in premiums, your first year commissions would be $100. That's 10% of $1,000. Year two, it would also be $100. Year three, it would be $100. Year four, it would be $100. However, if let's say you sold an accident policy or a hospital indemnity policy or a critical illness policy, you could have a heaped of, say, 45%. So if you were writing $1,000, say, in disability, you would have, on a heap scenario, you would receive $450 in your first year commissions total, and then a 5% renewal. So you would receive literally 5%, so $50 each year thereafter. So $450 the first year, $500 thereafter. So one of the things, a good strategy to do is to control your business. Understand that if you've got an employer where, say it's a municipality or a government or something where people are there an average of 20 years plus, right? One of those jobs and careers where people just don't leave. They stay there forever. And that's rare in today's world, okay? That's the truth. It's pretty rare in today's world, but there are still a lot of careers out there that do that. So if you're working with a company or an industry where that's the scenario, it might make sense to go levelized, right? But in today's world, and I would say about 90% of cases, what we found is, and oftentimes it's better to go heaped, okay? Usually 4 to 4.7 years is the break point. So if the average employee is there less than 5 years, it might make more sense for you financially to choose Heaped on a case. The beauty of voluntary insurance partners is you actually have control of that. You have autonomy with that. So when you're putting in a new case quote with us, you can speak to your executive partner and say, hey, these people are going to be here for 15 plus years. I think I want to get paid levelized on that. I don't need all the advanced commissions right up front. I don't need to make the first year commissions. I've got my renewals set. I'm vested in my renewals, truly vested in my renewals. If you want to know what that is, go back to the previous videos. That might be a good opportunity in certain cases like that. Not all cases, but I would say 5 to 10% of your cases. It's a pretty good way to go and to better diversify your income. Thanks a lot. I hope you found this very beneficial. I hope you have an awesome day today. Take care. We'll see you.